About 400 investors from the US, Europe and Africa gathered in Accra, Ghana yesterday for the 9th annual conference of the African Venture Capital Association. Citadel Capital is arguably the largest private equity investor in Africa, with a $9 billion investment portfolio in 15 countries in Africa and the Middle East. CNBC Africa's Wole Famurewa caught up with Karin Sadek, who's managing director at Citadel Capital, and started by asking his thoughts on why private equity investors should be looking more at Africa today.
I think from Citadel's perspective, the changes that have happened the past 10 years in the continent, a number of ranges that I'll try to cover quickly. Basically, a much felt improvement on the political risk environment. A number of countries have gone into processes and procedures of democracy and handing over power in a very organized manner. So you have had a reduction on political risk. Second, demographics. You're talking about a continent that's very young. With that median age reduction, you also have a sizable migration from countryside to towns and cities. And the third is a combination of the type of jobs many of the well-educated Africans end up having are the jobs that create a middle class that end up having surplus to spend. So our theme on investment in Africa has always been, as much as possible, to stick to either products or services that are directly linked to consumers, mass. Okay, we're not really after the high-end consumer who will consume one or two of that whatever high-end product you're producing, and the rest, it's a very limited market. And or indirectly that service that consumer base. So I think these two factors, and then to add on a third factor, has been definitely a big improvement on corporate governance within the continent and on managing macro risks. So I think these three have been a compelling story. You also have to add that the fact that over the past 10 years, Africa stands out compared to other peer markets as less disastrous when you compare it. I mean, look at what's happening in Europe. It's just telling, yeah.
Right, so let's consider the role of AVCA, that's the African Venture Capital Association, in all of this, in trying to attract the money, in trying to manage the money. What's the key role that AVCA has to play?
My view on that is, we do not have a big challenge on the fundamentals. So the fundamentals in many, and I would just do a caveat, I do not like to bundle Africa as one, because you obviously have different performance, different attractiveness. So in select African countries, and those are not one or two anymore, these are closer to 10 to 15, you have a situation where the fundamentals are great, very attractive for investments coming into the country. B, the money is listening, at least we have their ears. The issue, or the number of issues that the likes of AFCA should be playing, given that it's the body speaking on behalf of the private equity industry, is really addressing the remaining issues. Private equity globally has a very bad connotation, and through our own experience, what we do here has really very little in terms of likeness to the bad reputation of PE developed in the West and in the US. We are more of growth equity for inherent reasons, and because of the industries many of the PE get involved in on the continent. And as I said, the inherent reasons, this is much more of a growth equity story than it is of an LBO-like stripping asset, over leveraging. That doesn't happen. This just doesn't happen on the continent. However, that's a PR issue you need to deal with, and I think AFCA is very well situated with it. Second issue, on the private equity side, and again, whatever name you want to use, it's about you're either investing your money or third people money for a period of time, normally longer than what you would see in LBO-like situations. But the fact of the matter is you need to have an exit in as much as you have an entry. And the exit side needs a lot of interaction between the industry and regulators, because I think there is a lot that needs to be done on financial intermediation, in this case capital markets, to improve that likelihood of exit happening and of the ability to raise fund on these markets.
Talk to us about the changes you think we still need to see on the continent that will support fundraising. And by fundraising, I'm talking about fundraising internally and outside the continent.
the lack of liquidity inside Africa I think, is a bygone story. To a large extent, I mean, it's all relative, but I mean, there is definitely much more pockets of liquidity than many people would like to believe. Obviously, the public side of it is the various pension schemes and funds, and this is a natural result of having a young population. So any pension scheme has more inflows than it has outflows by virtue of, which is exactly the reverse of the developed world. But the point is, so there is a lot that needs to be done on pension funds, so on the public side of liquidity and insurance companies, to be able to allocate some of that money to unlisted equities. It is happening in some countries, not in all of them. The second part, I think, is very relevant and that is not covered a lot, is private liquidity. And I think here is another case where financial intermediation on the continent is not doing its role, be it savings and lending schemes like banks, basically commercial banks, or capital markets. Again, they are not doing the role they should do to attract private African net worth and investing it in productive assets. And the outcome, as you will, I'm sure you'll see, is with the improved with the improved purchasing power, real prices increase, because that's really the only asset that you would know that you'd earn a decent return in compared to what you would earn on a deposit in a local bank, or compared to what you would do on a stock market, given that it's not as liquid as you would like to see.